When it comes to investing, one of my favorite tools to understand the market is supply and demand. If you have taken Economics 101 in university, this will sound very familiar to you. Supply simply means how much the producers are willing to produce at a given price, and demand is how much customers are willing to buy at a given price. If the price goes up, producers are willing to produce more, and if price goes up, then people who demand it will also demand less. And vice versa, if price goes down, then there will be less producers to produce as much quantity and demand will go up. If you think about supply and demand, you should think about the extreme case. If something is free, then obviously there's a lot of demand. If something costs a lot, then there will be no demand. You can think about the curve of supply-demand as being a negative slope curve, meaning that the higher the price, the lower the demand. If it is free, then there's a lot of demand. The opposite curve is the supply, where there's a lot of products if the price is very high, and then there's almost no production if the price is zero. So then you get demand curve as going down and the supply curve as going up. This is how I think supply and demand. Now, supply and demand is useful when it comes to investing because it influences the stock price. If there is more demand for the stock, the price will go up. If the company is issuing more supply of the stock, like issuing shares, then the share price will likely go down. If the company decides to buy back the stock, meaning there's less supply of the stock in the market, then the share price will go up. That is really how supply and demand can influence the share price. Let me bring you to the whiteboard and show you graphically what supply and demand looks like. Price on one axis, and then you have Q on the other axis. So then this is your graph. And demand, we know that goes down as the price is higher. If the price is really high, demand will be very low in terms of quantity. If it is free, then there's a lot of quantity, so demand is a downward sloping curve. So that is D. And supply is the opposite. If the price is very high, they'll try to produce as much as possible. So is an S. If there is an increase in demand, which is going to be shown with this dotted line, this intersection you see in the middle is an increase in price and also increase in quantity. So that is Economics 101. So what does that mean when you're investing? So if you go to a chart, and let's say I'm using S&P 500 in this case, when the price bottoms out, that's when you see that there's a lot of demand for that stock because more and more people are willing to buy it. So when you're looking at the bottom, let's say here, this is really the demand zone, meaning that every time the price gets there, investors start buying because there's demand, and then it goes up. Whereas if you see a top, let's say here, this is called a supply zone where investors are willing to sell, and every time the stock price hits there, you encounter a sell-off. So by thinking about supply and demand for investing in the stock markets, you'll naturally end up trying to buy stocks at a discounted price. And by looking at the historical prices, you'll know that in which area it is a good time to buy. So for example, let's say back in S&P 500, July, there was buying pressure near 360. And then it went back to this range in October. You know that historically, there is a support level where there are a lot of buyers for S&P 500 at this price. And now S&P 500 has gone back to this area again. So what do? You buy at this price. Same thing for December and also March. It also went to this area again, and then it bounced back up. As price goes down, there's more demand. You would want to buy that stock, or in this case S&P 500, at discounted prices. And once it gets to a high, let's say right now is 430, it's getting closer and closer to the previous resistance area, which is the supply zone, meaning that people are willing to sell S&P 500 near around 460. You're getting closer. So it might not be a sell-off immediately today, but in a couple of months, once it gets to that range of, let's say, 460, 480 in this case, then you might encounter a sell-off, and you might want to book your profits at that time. So that's how you think about the supply and demand zone economically. So that is really the gist of supply and demand. And you can use this thinking model on used cars. You can also use this thinking model on news as well and how that impacts the stock price. For example, let's say you're investing in a commodity, lithium, and there's actually a lack of supply at the moment because they aren't able to mine as much lithium out of the ground for now. So that means there's a limited supply, and that leads to an increase in price. Now, on the other hand, right now we're moving towards the EV world, meaning we need a lot of batteries, which requires lithium as one of the key components of the battery. So then there's a lot of demand. And if you look at a lot of Bloomberg projection or Wall Street Journal projection, that's the demand for lithium will be increasing significantly over the next 5 to 10 years. So there's a very high demand for lithium. That means if you're investing from a sector perspective and you look at lithium companies, you will find that they're doing very well. And you will find that their stock price is going up significantly because there's a lot of demand for the company's products, which is lithium in this case. And there's not a lot of supply because they're trying to open new mines, they're trying to find new ores, so on and so forth. And that is a very good example of supply and demand in the stock market. Now, another good example is artificial intelligence recently. And one of the products that blew up is really ChatGPT, developed by OpenAI. It went from 0 to 100 million users in less than a couple of months. I think it's actually 30 days. And there's a lot of demand for artificial intelligence. One of the shareholders of OpenAI is Microsoft, and they got around 10 to 20% stake in the company. That means if you want to invest in OpenAI indirectly, you will need to buy Microsoft. And Microsoft incorporated the AI product into a lot of its other products like Bing and other future products like Microsoft Word, Excel, so on and so forth. So then that leads to Microsoft stock price to go up. And there's a lot of momentum behind Microsoft stock price right now because only the big tech like Google, Microsoft, NVIDIA are really into the AI race right now. So you'll see that their stock price is going up, which again, is a demonstration of the supply and demand principles. Now, another example is that back in pandemic, there was closure of various factories, farmhouses, and food/meat production. And one of the companies was Tyson Food, where they produce various meats like chicken, pork, and beef, and eggs. And during that time, they weren't able to operate at 100%. So then that leads to a reduction in supply of food in the United States. So that leads to the demand being constant, but lower supply, hence the prices going up. And this leads to higher revenue and profits for the company, and that leads to an increase in share price. So during the pandemic, I invested in Tyson Food and made a decent return on that as well. Now, here's another example. Back in pandemic, the tech stocks were hot. Everyone was staying at home, and there's a lot of demand for online shopping. So you will see the likes of Amazon, Shopify going up significantly. But as we step out of the pandemic, the interest rate starts to increase and everyone is going out to travel again. On Instagram, you'll see a lot of people going to Japan, going to Singapore and other Southeast Asia countries, especially North Americans. That leads to a decrease of people staying at home, working from home. People, are going back to the office now, even though we all don't want to. And that leads to a decline in business for these e-commerce companies. So one of the good examples is Shopify. In the post-pandemic world, Shopify stock price plummeted significantly. And let me just quickly show you how much. So at the peak, Shopify was $170. And after the pandemic ended, it went all the way down to $30 because the demand for e-commerce online shopping has declined significantly. So that means during that time, if you want to make money with Shopify, you will need to actually short the stock because there's not as much demand, and let's say the supply for Shopify is constant, then the prices will plummet. So as an investor, you can take on a short position to make money from Shopify. So that is pretty much it for supply and demand. So that means every time when you're looking at the markets, news article, or any additional information when you're evaluating an investment, you should think about, does that increase or decrease the demand or increase or decrease the supply? And that will help you figure out whether the prices are going to be going up or down. I'll see you in the next video.